Ahoy there, traders. How are we doing? How are you doing? Morning, Steve. Morning, Randall. Pop a yoo-hoo and a hoy in the chat box if you can hear me. So, just in case you're wondering if you're in the right place, if you're looking for information about swing trading stocks, swing trading the stock market, and all things related to swing trading, then you're in the right place. So, with that said, let's dive right in. See, everyone's logging in now. Everyone's just taking a moment or two to log in. Cool. So, this week's narrative is I've got to admit, it's a little bit of a show and tell type of session from my point of view. I'm just going to be talking about algorithms and automations. As it might suggest, I've got the latest version of the algo. So you can hopefully see for yourself that it's not just me talking about how good the strategy is. You can see for yourself without me saying how good it is. I'll share the data. Finally got the management part coded up, which took me, if you've been following for any length of time, you know it's taken several months. It's been pulling my hair out trying to get it done, but nonetheless, it's done. So that's coming later. So if you are new to these sessions, welcome welcome all. The way that these sessions typically roll are we're going to be talking about stocks, the markets, indexes, probably for about 60 minutes, maybe a little bit longer or a little bit lower. I'm going to spend 2 minutes just talking, introducing myself to some of the new members, new traders. We're going to go over the stock market, look for some swing trade setups, and we're going to look at rule-based trading. And that's all an algorithm is. It's a list of quantifiable rules that you could quite literally tell a computer to go and do for you if you so chose to. And that's all an algorithm, a rule-based, a logic tree, decision tree. You can call it a lot of different things, but generally accepted as rule-based trading or an algorithm. Where you get most value out of these sessions is get involved. I've got my chat box up on the other monitor, so if you've got a question, it's relevant, I'll answer it probably quite quickly. But like, comment, share, ask questions. If you're watching this on the replay, leave comments, smash the like button, all the usual stuff, and we'll have a good time and good fun. And again, if you've got questions, pop it in the comment box or in the chat box, and as soon as I see it, I will get a response for it. So my name's Phil Newton. I'm a trader first and foremost. I think it's important to mention that. I'm a mentor second because I love doing it. It's just in my personality. I enjoy it. I've got the luxury of time. I get to choose what I want to do with my time. Some of that time is spent mentoring and coaching other people to do the thing that I've become very good at. Again, I was very fortunate to get into this very early on. Amongst my other pleasures, I like rambling, working out, I like reading, the occasional single malt whiskey. I love cake, and I've got an unhealthy obsession with wildlife, especially flamingos. And I get to enjoy my life. And I'm not saying that to brag, but it is all because of production line trading, what I refer to as the system. And again, it's just a lifelong passion. It's become a way of life for me. So time is the most precious thing for me, and that's what trading gives me. It gives me those freedoms. For the last 28 years, I've been helping other traders become more successful and get profitable swing trading results. Again, I just want to reaffirm, I am not a Wall Street guru. I am quite literally just a regular guy who figured a few things out, and it turned out that I was quite good at them in what I call production line trading. It's what I refer to as my algorithm. I think about what I do as a production line, which is just a systematic list of rules and checks and measures, just like a pilot might have a pre-flight checklist. A factory would have a production line, and we're looking for trades to go along the production line to completion, and that's really what I'm doing. And a lot of what we're doing is quality control. We're flicking all the bad products, the bad stocks off the production line, so we only get the best produce that goes all the way to completion. From here on out, again, every week I like to try and give as much as I can in the shortest possible time that we have together today. To help you along your journey. For some people, it's enough just to know that what we do is possible, and just helps keep them on the right path. Some people do want some extra help and assistance, and I do help those that need help, just like we've helped Emily. She's one of my more recent success stories. Since being with the program, finally seeing results, making small risk trades, but making a profit slowly but surely. She went further to say that hearing other people who picked the same trades or agree with my reasoning meant that she wasn't guessing anymore. Again, I've helped, again, similar with Steve, with Anik, with Joe, with Kyle, with Colin, you know, and Rodrigo, Kyle, Steve, again, you're on here, mate. I can see you in here. You know, there's lots of success stories of people who are doing well. Sometimes it's mixed results. Sometimes it's, you know, championing the lessons learned from a losing trade. But nonetheless, helped each and every one of these people get some measure of success so that they can see the successes that I've had. Again, I love a good read, a ramble, flamingos. It's, again, an unhealthy obsession. And again, it's all because of production line trading. There's three elements to this. The mechanical scan, we're going to go through that later, visual confirmation, and the trade craft. We're going to look at all of those three components today in, and Randall, there we go. Yeah, sorry, dude. Left you out there. You're on the scoreboard too, my friend. It's nothing personal if I didn't mention your name. But the idea is it's replicatable, and this is why I refer to what I do as a production line. As I mentioned earlier, I do have an education business. There's no pressure to sign up. I said I'll give as much away as I can in these free sessions, but just a quick commercial intent warning. You may be invited at some point to come and work with me. If you want it, it's there. If you don't, and you just want to watch the trader TV that we do every Friday, and you know, kind of patchwork quilt your own trading routine together, that's cool as well. I'm okay with it. But nonetheless, if you do want to work more closely, there is a group program. I've got no time for one-on-one mentorship at the moment. Again, I've got a full dance card for December, which involves going and enjoying myself. So I've got little time for new one-on-one mentorship with students at the moment. There's three elements to the production line. Excuse me, there's three elements to the production line. And the first one is mechanical assessments. It could be a trend, which we're going to focus on today. Usually I like to have a visual confirmation. Now, obviously with the automation, that gets taken out of the equation. So we're going to have less focus on the visual confirmation. Again, I do like to add that manual step in because some things we just can't automate. So we're going to focus mainly on the automation side today, which validates everything that we're doing from the trade management and the entries, the exits, the stops, the targets, but there's just going to be less focus on the visual confirmation. As I manually, I don't actually auto trade. I just can't relinquish it because I like to add that manual step in. I actually find that it improves my performance because some things you just can't quantify. And if you speak to anyone who's, you know, in the trenches with system trading and algo trading, I remember speaking to one gentleman actually many years ago, and he was quite literally an automated algo trader, and he would have 20 algorithms running at the same time. He's a very short-term 1 to 3 day trader. And I remember him saying, so the only thing that you can't program is how to evaluate market conditions. So what he pretty much used to do was he would let his systems trade, again, 20 or so algorithms live or going at any one time on currency markets as it was back then. And he would just let the system trade, but he would spend his time monitoring them and turning them on and off because he would evaluate the markets or the instrument that he was looking at as not being right for certain strategies. And he would just pretty much spend his days turning the algorithms on and off because that's the only thing that, as an expert, you know, coder and writer and evaluator, couldn't be quantified by mathematics. I don't quite agree with that level of automation, but the way I like to use automations, which is what we're going to focus on later, or shortly rather, is to validate what we're doing. Algorithms and automations, it can be quantifiable. Again, I don't necessarily want a computer to do all my trading, but at the very least, I want to validate, like, does this strategy that we use, that we talk about every week, and that certainly I've been trading for the better part of, when was it? I think this version of the strategy has origins from back in 2002. So it's been used for a long time. I refer to it as classic trend trading a lot of the time, but I think it's a modern twist on classic trend trading, which we will see shortly. Nonetheless, we're going to be looking at rule-based trading. That's the end of the slide, you'll be pleased to know, folks. And we're going to be looking at rule-based trading. And as always, if you've got a question, leave a comment, raise your hands. And if you want to hop on the mic, let me know. I'll allow you to talk. If you want to have a little chat about it, then let me know. So let's go and nerd out on some charts. There we go. So as always, the first place I'm going to start when I'm looking at anything is I'm looking over here on the left. I usually do this on my mobile. I've got a little list of, or I've actually got the TradeStation app. Again, whatever charting platform that you're doing or that you prefer to use, just have a list of the markets. Again, it could be the index. I've got the futures there. The second section is actually the same list of instruments, but just via the ETF. And then the section here is just, you know, a representation of, you know, it's a little bit more than the FANG stocks, but basically just a list of the big capitalization stocks. All I'm trying to do is get a snapshot of the market. So the first thing that I'm doing, and the market's just about to open, so there's not really any significant advantage, but usually, because I'm based in the UK, usually about mid-morning, so about 5 hours before the market in the US opens, I'm looking at the figures. I want to try and get an idea of, you know, has Europe got any influence, or is there anything going on in the Asian markets? So row number 6 here, you've got the Nikkei, so you've got the Japanese index, the rest of the US. But I'm just trying to find out, you know, based on the Globex traded futures, which trade for about 22 hours every day. So effectively they're 24 hours. I can see what's going on in the world of what we refer to as the stock markets. And all I'm looking at more than anything is the percentages. Is anything funky or weird going on? So I'm just highlighting the, over on the left there, the percentages. Is there anything funky or weird going on? And that's all I'm really looking at from that perspective, to try and get a gauge on, do I need to panic for the day, essentially? Is there anything that I need to do? Should I be excited? Should I be annoyed? Should I be pissed off? Can I go out for the day, essentially? And really, it's just if the numbers, the percentage of movement is greater than normal. So stocks are going up, always nice to see. It's in low single a fraction of percentage, so 0.2, 0.3, 0.4. The Russell's up 0.7%, so that's leading the charge higher. So that's looking good. So it's not really showing me anything out of the ordinary from that point of view. It's a little bit elevated, which just means that we're going to see probably the market's gap higher at the open. Excuse me. Now, if we were looking at, you know, which is what we saw Monday, Tuesday, Wednesday, Thursday, the market was up 1-2% before the market opened. It was down 1-2% before the market opened. So there was something clearly funky going on this week and at the end of last week. You know, that's what you can see in the market. So that just gives me a measure of, is there anything for me to worry about? You know, maybe I need to spend a little bit of a time at or near the open, just checking the portfolio with a little bit more of a keener eye and a sharper pencil to cross the T's and dot the I's. Whereas if nothing funky is going on, then I probably don't need to worry about checking in. Because I'm swing trading, I just need to monitor things on a day-to-day basis. I don't need to be at the trading desk on a daily basis for hours at a time. So that's really the thing that I'm looking at. So because of the elevated volatility, I am closer to the desk. I'm usually not far away at the moment, just to keep an eye on things. Again, I'm still not sat here scrolling through chart after chart after chart. That's the one thing that I do rail against. But how do I evaluate whether I need to spend a little bit more time and pay a little more attention? Is just simply by looking at the overnight futures. Is anything weird going on? Is there a crash coming? Is there a correction coming? Is there anything weird or funky? And that's all I'm checking there. Now, it's one of those things, it's a little bit abstract. There's no rule-based thing here. It's just observational data. What you'll pick up, even after a few days of doing this, I'm just highlighting the numbers here. Even after a few days of doing this, you'll see, oh, it looks like the normal range of movement before the market opens is usually not that much, but it's usually between 0.2 and 0.4%. That's kind of like a normal, quiet overnight trading session, or a European trading session, or an Asian session. So that's what you'll note there. In the regular market hours, you might see, you know, up to, you know, 0.6, 0.8, 1% of the movements of net change as a percentage. That might be at the upper edge of, you know, that's been an interesting day. and that's what you'll start to make. It's more observational. And again, it's the only thing I can't give you. I can give you kind of what I see and what I'm evaluating and the benchmarks that I'm just checking. But you'll be able to see, like, is there anything for us to panic over? So last week, early this week, the markets were, plus or minus 2%, which was a little bit more volatile than normal. It's not really outside of the realms of what we've seen for the rest of the year. So when you start watching these things, because of all the weird stuff that's going on, I probably don't need to explain anything. This sell-off that we've seen, we were talking about this 3 weeks ago. This wasn't a surprise for us. But the fact that we were going, up and down 1 to 2% during the pre-market or even during the regular session, it's not out of context for the sell-offs that we've seen all this year. So it's not doing anything out of the ordinary. It's just at the upper edge of its normal range of movements during a sell-off, which is in the theme and in context for the rest of the year so far. Let me pause there. Does that make sense? I sometimes worry about these kind of observational comments, but it just means that I don't need to stress. I don't need to worry. I don't need to tighten stops. I don't need to freak the F out because it's in the realms of normalcy. Does that make sense? Let me pause there. Awesome. Don't worry, be happy. Absolutely, Steve. Yeah. Duncan, yeah. Looks normal on the chart. Duncan, that is the absolute point I'm trying to make. It looks normal on the charts, but when we live through it in real time, it's scary, but it just like every other time it happens. Like I was not impacted by the sell-offs because just like everyone else, I was like, oh, the markets are selling off. It's big red day. It's going down. And then you look at the percentages, and because I'm watching this and I check in for just a few seconds, 2-3 times a day. Oh, we're up, we're down, whatever. It's not really a huge amount, and you'll make that observation, and then I can make those affirming statements. It's nothing out the ordinary. Yes, it's painful. Not going to deny it. It's sitting through a retracement. It is like getting kicked in the shins. It's frustrating for me as well, but it's not out of context. I think the other thing to keep in mind as well is that, we were talking about a sell-off. Again, we were talking about if you remember, 3 weeks ago now, we were talking about a sell-off being potential for particularly prominent on the Dow. Again, main thing is we had nothing new happening. We had this rising channel, and we could also say that we're at the upper end of a barrier point, a resistance point, and we had one of our lovely little V-shaped patterns. We've got a second one there, but we said we were looking for the potential for price to reverse in the context of a consolidation. So we've got this rising or expanding wedge, however you want to phrase it. It might evolve into something else. We could probably draw a trend line and call it a rising channel now. It doesn't really matter what we call these things, but we had a barrier point that was very clear, very prominent, very obvious. We can see the same things on the Nasdaq. Again, we've got a lovely rising channel, long-term most of the year. Not seeing, only really just triggering now. If there is going to be a sell-off, Nasdaq might have its own little isolated events. But again, just coming back to the Dow, we were talking about this several weeks ago. So it shouldn't be a surprise that we saw a sell-off. So we can position ourselves ahead of a potential sell-off. We can start looking for bearish trades, which is what we did at the time. We started looking at some bearish opportunities. Me personally, I was looking at trading some futures, just to try and get some bearish exposures from short-term, 1 to 3 day trades. That was how I dealt with this, because we knew in advance it was coming. We spoke about it in real time before the event happens. For me personally, the only thing that was a surprise, was the speed of movement. I didn't think it was going to happen over such a short space of time. And that's my opinion. The speed of movement is always going to be the unknown elements, the unquantifiable elements when we're looking at the markets. The fact that it happens, for anyone who's been with me for any length of time will know that it was not a surprise. Just that speed of movement is a little bit scary. And as you said there, Duncan, as we're going through it in real time, it kind of puts the willies up you, just like every other time it happens. But knowing not to have a knee-jerk reaction to these events is the critical point. You can start to say things like, well, I'm already hedged. I've already got bearish positions. I've already got some bearish exposure. I've locked in profits. I've closed bullish trades. I've pared back. However you normally manage your positions, you can start to prepare in advance for these events when they happen or if they happen. And if they don't happen, that's fine. We can always get repositioned. We can always get back in trades. It's not a big deal. But nonetheless, that's what I'm typically looking at. The first thing is those percentages. Then the next thing I'm looking at is, now we're looking at the charts, we can start looking at, where is price in the context of what we're looking at. So in the case of the Dow, it's in a consolidation. No one's in any doubt that price is contained. Again, let's just draw a parallel trend line. Let's just see where we've got some new information since we first drew this. I'm just going to see if we can catch some of these lows. That could be interesting. I'm just kind of struggling there. I think I'll leave it as it is. My view is, if I'm going to draw a sloping trend line, it needs to be bloody obvious. So let's leave the horizontal there. We could also say we've got some horizontal support here. Just catching the 200 period moving average. Again, it's usually a dynamic support level, but nonetheless, I think we're all in agreement. It is contained. It's consolidating. Again, I don't really care about the name of the pattern these days, to the point where I don't care about the name of these patterns. I just want to recognize what's the phase. Is it going up? Is it going down? Is it going sideways? Because then when you know one of those three things, you can do what we've just said. You can prepare for the possibility of certain things, happening. So as price is in a range, well, where is price in the context of the range? Again, we're looking for three things. It's going up, down, or in a consolidation. That gives me buy the dip to sell the rally, or I can buy range lows, sell range highs, buy the breaker range highs, or sell the breaker range lows. There's four things I can do inside of a consolidation. So now I want to know is, like, where is price in the context of a consolidation? Well, it's not quite at the extreme low that we've got marked off, but it's certainly at, kind of like inside support level, if you like. We could quite easily say we're close to prior support, and price has stopped here multiple times. 34,000, big psychological round number. Let's call that support, for want of a better description. So we're at a range low. So I've got to be thinking bullish at the range low. And I'll be thinking bullish all the way down to 33,000. So there's a big 1,000-point range for me to be bullish in, if we're going to be a little bit pedantic and include the extreme low here. So I've got to be bullish. Got to be bullish. What do we think is going to happen next? The whole philosophy behind charting, with any trading philosophy that you follow, it's Dow 3, GAN 3, LOA 3, is that the same thing is going to be assumed to continue to happen until something new develops. So the whole purpose of recognizing the up, down, or sideways phase is, now that we know that this is in a range, we've got to presume that that's going to continue until something new happens. Something new would be a breakout, up or down, doesn't matter. That would be something new. It's out of context what's been going on. But as price is still in the range, it's at the range low, I've got to be bullish and presume it's going to go back up. I don't know how long, I don't know when. No one knows the when, so let go of it. What I do know is that until something new happens, a breakdown, a breakout, it's going to continue to range bound. Again, if you don't believe me, go and look at things like Netflix. Netflix, for the better parts of last year and this year, buy range low, sell range high. When you've got three touches of the range low, the range high. So at this point here, we speak about this quite regularly. You've got three touch points. Why three? Because any fool can connect two touch points. Three touch points, three crosses in your average price. There's your mechanical evaluation of a range. At that point, something new has developed. Prior to that, it was trending. Now it's ranging. Mark off the high, mark off the low. Buy range lows, sell range highs, buy range lows, sell range highs, buy range lows, sell range highs. Didn't quite get to range lows. We spoke of that in real time. If you remember, I missed my buy opportunity. There was no sell opportunity. Now we're into buy the dip. This is what something new looks like. You've got before and after. Great. Now you know. If you don't believe me with Netflix, go and look at NVIDIA. Go and look at Halliburton. All ranges until something new happens. The same thing has got to continue. We went through this in real time. Sell range highs, profit from a downward movement on Halliburton. Now we're at the range low. Well, guess what? Price is making a lovely V-shaped pattern, something that we look for. We've got to be bullish at the range low because nothing new is developing. I've got to trade it up to the range highs. Cool. I think we all get the point. This is why looking for the trend is critical. It's the simplest thing that you can do to improve your trading. Determine the trend. Number one, buy the dip. Number two, sell the rally. Number three is buy range lows. Number four is sell range highs. Number five, buy the break of range highs. And number, where I'll be six, is sell the break of range lows. There's 6 things. There's actually 8. We could trade counter trend. I just prefer not to do it. Nothing wrong with it. I just don't want to do it. You still need to know what the trend is to trade counter trend, whether it's up or down. Just keep that in mind. So when you know the trend first, and I say this every week, God damn it, it's the most important thing ever. Doesn't matter what you do next, whether you're what widgets, what tools, what whiz bangs, whether it's Dow, Gann 3, Elevate, whether it's moving average, RSI, CCI, stochastics, blah, blah, blah. Insert the tool of your choice. It doesn't fucking matter. You've got to know the trend first. When you know the trend, it tells you what to do next. Look at the last 12 months. So look at least 12 to 15 months of data. Look at our average prices. They're going up 250, 20. Great. That's a nice mechanical evaluation to help us determine what the trend is. When you've got 3 crosses in the average price at a relatively similar level, either horizontally or vertically, we've got to call it a consolidation. We've got 4 here. It's still a consolidation. You've got to call it a consolidation. So we can have a mechanical evaluation. We can also have a visual inspection. This is part of the production line process. As soon as you look at an opportunity, evaluate the trend. What's it doing? Well, it starts at the bottom left, it finishes at the top right. Okay, well, initially it looks like a trend. Actually, the 20 crosses the 50 once, 2, 3, 4 times. Okay, so we've got a mechanical evaluation. We've got a long-term trend and a short-term consolidation. Short-term in this case is define the time horizon, about 6 to 8 months. That's okay. But you've got to go with what you see. Mechanical evaluation, visual confirmation, great. Now I know that. I know what to do next. And that's the whole purpose of this. So that's how we evaluate. So let's think about what we think is going to happen next in the market. Whack the range lows, got to be bullish. Let's go to the S&P. SP 500. We've been talking about this. Rising channel. Something new happened over here. All I did was drew this parallel trend line. It came down to that. We've got this prior resistance here. We've got this rising trend line. Again, we commented on this last week. This was the potential for where it could get to. It's almost like X marks the spot. It doesn't surprise me that it got there. It makes me smile every time I do these things. Again, I'm not doing anything clever or creative or fancy. Nasdaq, what's it doing? Multiple crosses in the 20 and the 50. Okay, this time it's doing 2 things. It's both going up, but it's also contained. We've got multiple touches of lows, multiple touches of highs that are very close together. So it's both trending and ranging at the same time. So what I do in this case, when we've got a channel that's angled, in this case, a rising channel, we'll call it, I'm going to default to calling it a range. I've got to be bearish at the range highs. I've got to be bullish at the range lows. And it's probably going to continue until something new happens. Let's go back to the S&P. We've just seen this happen on the S&P. Let me just pop it full screen. So you've seen this happen on the S&P. When something new happened over here, it broke that channel low. I thought we were going to transition into a range. Again, just my opinion. Obviously, it was proved incorrect very quickly. But price is going new highs. It looks like it's developing a new parallel rising channel, which could be interesting. So we can see the same things unfolding time and time again. The Russell is our favorite. Something new attempted. Multiple cross in the average price. At this point here, we've got to call it a consolidation. 1, 2, 3. So where are we at? We're looking at the potential for a breakout, pullback. Needed to hold. It didn't. Where's it come back to? Back to the range lows. I've got to admit, my opinion, my personal viewpoint, I didn't think that would happen. Doesn't matter what your opinion is when you've got a structure to evaluate things. What is price doing? Well, there's the range. Mark off the boundary high, mark off the boundary low. Don't worry about the label. Don't worry about calling it a name. We could certainly find the triangles, the wedges, the pennants, all the patterns. I know 34 different named patterns before I stop giving a shit and stop counting them. It doesn't matter. It's in a range. Just mark off the boundaries. Most times it's going to be a horizontal lows. So where are we? We're at the range lows. Didn't get there? Said that last week. Said that the week before. But lovely pullback, broke back into the range, and down she goes. You know, the philosophy of the looking for these market structures, these 6 money making blueprints, it just blows me away every time. It's based on these principles. Lovely little segue, Phil. It's based on these principles that we keep going at, that the strategy that we use, the classic trend trading. Where's my thing? The classic trend trade. There we go. The classic trend trading that we use. It's those principles that we use to. There we go. There we go. Let's try again. A little bit of a rough segue, but nonetheless, a segue nonetheless. It's the same principles that we use to identify structures. So, analyzing the markets as a whole, I'm going to do what we've just done. I'm going to use the 6 money making blueprints to help me figure out, should I be looking for bullish trades? Should I be taking profits? Should I be locking in profits? Should I be hedging if I think there's going to be a bearish movement? If I think there's going to be a bearish movement, maybe I do all of the above and look for bearish trades. That's what we did 3 weeks ago. We looked for those bearish opportunities, the bearish setups. We locked in some profits. We went into Thanksgiving. I wasn't really looking for new positions because of the short trading week and the holidays, etc., etc. But I tidied my portfolio based on the viewpoints, based on the lens that we look through. Now let's use the same lens to look for trading opportunities, look for trending opportunities, and then let's look at how do we automate the process so that we can validate, is this a good stock? Is it the right stock? And, you know, make sure that we're following the rules as best we can with structure, with consistency, and not just validate the strategy, but validate the list of stocks, the universe of stocks that we're looking at, because not every stock is worth trading. Like Kellogg's, everyone's heard of Kellogg's. I'm sure we've all, at some point in our lives, ate the breakfast cereal. But just because it's well known, it's liquid, it's highly tradable, is it worth flogging a dead horse, essentially? You know, for quite literally, if you think about what the market has done in the last 20 years, since 2009, we've been in a raging bull market. What's Kellogg's done? As my dear old beloved Pappy used to say, what is it? SFA, Sweet Fanny Adams. It's done nothing. It's done nothing, despite the huge trending moves. It's just one of those stocks that, while it's good, it's making money, they've got dividends, it's just not doing anything. And that's okay. There's a different style of trading that I can apply to Kellogg. And I need to know that before I go live on a trade. I would trade Kellogg's in a very different way. I would probably sell options because it's going nowhere. I could probably buy stock and sell covered calls. I could probably just buy stock and collect the dividends. It's a different style of trading, but we need to know, is this the right stock or the right group of stocks for this style of trade? Now, I want to profit from movements. I want to profit from, press the button, Phil. I want to profit from movements. So back to Jeffries. So I want to profit from swings. I'm a swing trader. I'm pretty good at picking direction. So I like doing it. I'm going to do the thing that I'm good at. But let's validate it. So we haven't been through the swing trading strategy for a while. We usually use Twitter as our example. We've used Twitter for most of the year. But nonetheless, this is just what I've been working with, trying to automate and validate the strategy. So the first thing that we do, and this is what we teach all what I teach all my students, is the first thing we're going to do is, how do we buy the dip? What is the trend? How do we buy the dip? How do we quantify the dip? Just because price is moving down doesn't mean you should be buying the dip. It might not be dipping, because we need to know what the trend is, as we've just been talking about, before we can buy a dip. What if Good example, Alibaba. Alibaba. So many people are talking about buying the dip on the social medias and the Twitterverse and all the other bullshits and the talking heads on the TV. They're talking about Alibaba as buy the dip, baby. It's not fucking dipping. It's clearly going down. It's in a downtrend. Down. Sell the rally. Think about it. I'm not saying that Alibaba long term is not going to be a good bunny fingers time investment, but think about it in the short term. Like in the short term, it could be 1 to 2 years, maybe 3 years. So sell the rally, buy the dip. So that's what I'm trying to quantify. Back to Jeffries, JEF. So what I'm trying to do is recognize what the trend is, because when I, as we just said, if I know that the trend is up, I can start to quantify a dip buying opportunity. Let's do it. There's four rules for us. There's 4 rules. Number 1, average price, the 50-period moving average needs to be above the 200. This is your classic trend trading combination, the 200 and the 50-period moving average. And if you're only reading about it, if you want to Google it, if you want to noodle it, if you want to Yahoo it, I don't know what search engine you prefer these days. But if you want to look at it, it's usually referred to as a golden cross. The bearish version that we just looked at on Alibaba would be a death cross. Don't roll your eyes at me. I didn't make these names up, but that's if you want to go and research it for yourself. So the first rule is the average price needs to cross the 50 and the 200 needs to be on top of each other. Again, we're just going to focus on the bullish side and we'll take it from there. So the next thing we want to do is we want to wait a period of time. Now, up until this week, I would previously have said we're going to wait 40 days. And for any of our long-term viewers, they all know that it's been 40 days for about 12 to 15 years. I've said that for a long, long time. However, because of the magical power of automations and systems, I can vary that. This is one of the things that I was able to test with thousands of data points, because at the click of a button, I can say, is that actually the right rule? So now I'm going to say that that's 20 days. Just generic. There's actually a little bit more than that, but I'm just going to go 20 days. So it used to be 40, now it's 20. And again, it's because of automations. I can validate, is that optimal? Again, it's a little bit of a generalization. What I don't want to do is curve fit. I don't want to fit the strategy to the data to pull out the perfect tops and bottoms. That would be a bullshit way of using automations. I just want to validate a range, a generalization that I can use across the board. So I'm going to bring that down to 20 days. So now the average price needs to be crossed for 20 days to help me avoid the false starts and the whipsaws. I also want to see price moving upwards. You can look at that as a percentage. So again, number 2 is 20 days. 20 days in trend. Number 3 is price is actually moving as a percentage. Anywhere up to, 5, 8, upwards of 10%, in a 60-day period. So it's going to look back 60 days. And as long as it's moving upwards, it's just going to help filter out the times where the average prices cross over and it doesn't really go anywhere, because that does happen. So we want to make sure that our average price, the mechanical trend, is giving me a bullish indication. Now, this is also a mechanical way of saying, is price moving? I normally do that. Step number 3, I would normally do that visually. So I can take that out and put this criteria in to keep it all mechanical. And that's how we can just take it out of the equation and run the back test. So is price actually moving favorably? Yes or no? If yes, start looking for the dip. So now we're on to the dip part. So we've got one rule for the dip, buy the dip. Essentially, when price comes back below the 20-period moving average or the 50-period moving average, that's going to be my zone for quantifying a buyable dip. So let me just put number 4 over here because I'm running out of space. So 20-period moving average, 50-period moving average, price needs to retrace back to those levels, and that will be my buyable dip. Now, just because it's there, like right now, just because it's there is not an automatic buy. I'm going to wait for price to go back above the 20 or the 50, 20 or 50, before saying, okay, that's my buyable dip. I'm going to wait for price to be moving favorably back above. So it's got to come below. That makes me interested, smiley face, interested. Then I'm going to wait for price to turn around. When that happens, That's when I'm getting in the trade. So that's essentially the classical trend trade, the modern version of trend trading. These are all quantifiable rules. I'm giving you the back of the envelope version, but I can basically say when those conditions happen, 4 conditions, 3 of them are to determine the trend. One of them quantifies a buyable dip. Whew. Let's press pause. Everyone cool? Does that make sense? I'll let you pause, take a screenshot, whatever you want to do. It's just code for me having a quick drink. Cool. Excellent, excellent, excellent. So this is what I've been talking, this is what I've been teaching for years. This is generally how I've traded all my life. Variations of this. My original iteration of this was on 15-minute charts. Zeke, you'll appreciate this, my friend. 15-minute charts back in 2004, 2005, using 100-period moving average as my kind of like longer term trend, and basically go long above and short below. And I would buy pullbacks above the above the 100, or sell pullbacks below the 100. You know, it's simple because it works. Now, here's the magical part. You don't have to take my word for it. Why? Because guess what? We're going to code it up. We're going to put this into a fancy little algo. I'm going to turn the damn thing on. Classic trend right at the top here. Straight back from the coder, the programmer, finally quantified the money management elements. So, let me just zoom in. So what we've got might be a little bit difficult to see just because of the color scheme. I think oh, there we go. So we got buy the dip, rally retracements. Again, not quite reaching a profit target. So it's just closing on, if it goes back below the 20-period moving average, kind of management. This one's out here because it met a profit target predetermined or predefined that I teach all my students. Takes a re-entry, gets stopped out again. Not all of them work. Gets you back in the trade, manage it. There's a profitable trade there. Gets you in, profitable trade there. So right now it's in a holding pattern. So the point is, the rallies, the retracements, all we're trying to do is when price is above the 200, above the 50, above the 20, go long. Happy days. If it comes back below the 20, manage trade for a profit. That's all we're doing. Nothing fancy, nothing complicated. I've been teaching this for many, many years. There's a few obviously nuances to this, but if we didn't want to look at any discretion whatsoever, the management of the trade has now been coded in. Let's look at the reports. So again, this software does something fancy. It basically creates a performance report. What I want you to note is I'm not cherry picking a year. This is going back from 1999 or as much data as we've got. So that's the first thing. I'm typically looking at 3 things on this. The first one, the all trades. I'd like to say make money long and short. It separates them out for me, but I'm looking at the percentage profitable on this stock, just doing what I've told you. Buy the dip in a quantifiable uptrend. 61.43% of the time in the last 20 years, you're making money. Great. Or you've got winning. Now, the next thing, because a win rate on its own is complete bullshit. So just keep that in mind. If anyone's talking about 80% win rates, 60% win rates, 100% win rates, it's all bullshit on its own, because you've got to then check, does it actually make money? All trade. So net, there we go. So does it make money? We've got a win rate and it's making money. It's got a profit factor of 2.78. What does that mean? That means you put $1,000 in, you're going to get on average $2,780 out. It's got a multiple. You're making money and you've got a profitable win rate. So they're the 3 things that I'm looking at there. And then the final thing is I want to look at the equity curve. So over that last 20 years, you've got a lovely, steady equity curve. That's what I'm looking at. Now let's go back to Kellogg's, because I said that Kellogg's is not great. Let's go back to Kellogg's. K is the symbol. Let's see if Kellogg's is a stock that I should trade, a trend trading strategy. I'm not saying that Kellogg's is a bad stock. It's probably a good investment. As we said earlier, it's great dividend playing stock. If you want to cash flow, apply cash flowing strategies like selling income, selling premium, then maybe Kellogg's is the stock for you. But it is not the right stock for a trend trading strategy. It hasn't had any interesting movements. Again, in the last 20 years. Why would you want to trend trade Kellogg's? So now what we get to do is, before you pull the trigger on any trade, and this is one of the things that we have, or the beauties that we have with systems, with rules, with algorithms. We can do it manually, but I can also say, should I be trading this stock? Yes or no? Well, Kellogg's is not going to be in my universe of stocks to trade. Why? Because it sucks. You're winning 43% of the time. That's pretty good. Like, as systems go, that's amazing. Winning, and this is what I mean by, on its own, a profitable winning percentage is absolute nonsense. So don't believe anyone who doesn't give you the full picture. You want to look at, I'm making money 43% of the time, but are you actually making money? No. Well, that's not a good strategy. You're putting $1,000 in, you're not even getting your money back on the trade. And so that's the point there. You're not making, and if you are going to trade it in the last 20 years, you're quite literally flogging a dead horse. Is the juice worth the squeeze? Probably not. So don't worry about trading Kellogg's. You're not missing out. We've firstly validated the strategy. We've also just validated is this a good stock to trend trade? No. Well, don't worry about it. Let me just catch up on the comments, take a quick drink. Does this make sense, folks? I mean, what we're trying to do is find an edge in trading. It doesn't have to be a big edge. You don't have to have the big percentage. It's just convenient that Jefferies, one of the stocks that I was using as an example to the programmer, is actually a really good stock. You know, you're winning 61% of the time. With the classical trend trading strategy, you're winning long and shorts, which is great. You could go long only. You'll be making money 68% of the time. You'd put $1,000 in, you get on average $4,000 out. That's pretty cool. I like that. Absolutely, Zeke. I was going to take requests actually. So Zeke and one or two other people are already putting some requests in. So let's go and do it. And let me just catch up on the comments actually. Suleiman, I'll answer that later if you don't mind. If I forget, I'll take a screenshot and send you a private message, just because it's a little bit off topic today, but I'll give you an answer later. So yeah, let's go look at some tickers. I will be open to taking tickers. I think the first thing that we should do though is go and, let me just pop that over here, not necessarily out the way. But let's go and take a look at the market. Let's go and take a look at the Dow. So it should be, there's a natural bullish bias. Oops. Oh, don't crash on me now, TradeStation. Don't do it to me. Don't do it to me. There we go. Ooh. Panicked for a second there. Right, let's take a look at the Dow. Dow futures. I like using the futures. We've got a lot of data. It's 24 hours. It's not gappy. Again, I'm just zooming out so you can kind of see the last, the last 12 months on the screen. We've got the report there. Now, what we'd want is we'd expect a trend trading strategy to perform moderately okay on the markets. But if you're making, what is it? If you just buy and hold, I think the average return on the index or the market's going to be 8 to 12%, depending on which report that you read. So you should be able to buy at the beginning of the year, and at the end of the year be making 8%, somewhere around that. That's the idea with buy and hold strategy, because everyone compares it. If you just buy something, close your eyes and come back in 30 years, you'll make an annualized 8%. So that's the logic. So the idea of trading to be a little bit more, not like super active, but a little bit more proactive, and just getting in and out when prices above the 20, above the 50, and above the 200. If you just do that, you should be able to make money. Obviously, exceptions to every rule. You're going to lose some money there, but there is exceptions, and are exceptions to every rule. But if we just look for any of my insiders, a phase 3 trend is what we're looking for. Then you should be able to see some interesting performance. And now the markets with the classic trend trading strategy, this becomes the benchmark. In the last 20, almost 20 years, not quite 99, it's got from 2002, but I should be able to make 61% of the trades profitable. Again, we know that in isolation, that's a bullshit figure. We want to then just check, is it actually making money? Yeah, if I put $1,000 in, I'll get $100,000 out or more, 106. Now, just to come back to the point, this is not compounded, by the way. This is just $1,000 in every trade, no compounding. Just imagine what you do if you're compounding, increasing position size when it makes sense, applying good money management practices. Who would have thought? Profit factor 1.87, looking good. How steady is the equity curve? What I don't want to do is sit inside a roller coaster ride of performance. Well, there we go. So we've got a nice steady performance. Okay, it's not as smooth as Jeffries, but nonetheless, it's a nice steady equity curve, which is good. That's what we're looking for. Let's go and check out Halliburton, an oil stock. Oil futures doesn't actually seem to perform too well, but nonetheless, Halliburton, I like using this as a proxy for what I'm doing. Again, a little bit of that roller coaster experience. Although it doesn't look like it, you do have new equity highs going on in there, but you've got a good equity curve. It's not the best one compared to what we've looked at so far, but nonetheless, it's never been negative, never been losing you money. Again, you're making money about 57% of the time. You've got a reasonable profit factor, and you're actually making dollars as opposed to it costing you money. So that's what we're looking for. That's validating that Halliburton is good long-term over a 20-year period. And again, visually, you can see it's even working in the last, last 20 trades. Let's call it the last 2 or 3 years. We can just check the last part of the chart. So long-term, we can also visually check, is it working now in the most recent market conditions? Actually, yes, it is. Cool. That's what we want to know. So we're validating the 4 rules. 3, quantify the trend. The 4th rule, to define a dip buying opportunity and the management of that. I'm using ATR, average true range, to manage stops and targets, and the in-trade management if it doesn't reach targets, if it goes back below the 20-period moving average, as I mentioned. So very simple, back of the envelope explanation of what we're doing. Don't have to take my word for it that it works. Here's the proof, it works. Question from Zeke: should we trade Visa with a classical trend trading approach? Let's validate it. What do you think? What do you think? Should you trade Visa? Let me know, my friend. Let's throw it out. Who wants to take credit? Just here's the chart. We're looking back. Now, this is since 2008, just for reference, 2008. But should you trade? Yeah, it's not as good as Jeffries. I'll give you that. But long term, it's a nice, steady equity curve. Nice and steady equity curve. That's what we're looking for. You just look at the last block here, last 10, 15, 20 trades, the last 1 to 2 years. It's also good in the short term. That's pretty cool. I like it. Should it be in your universe of stocks to trade? Yes. Let's just go and check out the specifics. Again, you're making money 57% of the time overall. That's good. 57% of the time. In isolation, we want to ignore that. So we want to go to, is it actually making money? Okay, from it's about making about $10,000 and profit factor of 1.7. That's pretty good. About 1.7, 1.75, that would be what I would be looking at. If we're looking at a profit factor of 1.0, I'd probably not be too excited. Your P&L is going to be positive, but you want the risk to reward to be there. You want $1 in, you want $2 out. You want $100 in, you want $200 out. You want $1,000 in, you want $2,000 out. So that's what we're looking for. We want a return on the capital that we're using. So again, this is just reinforcing, it's not about the win rate. It's about win rate plus profit factors plus, do we have an edge? And a win rate is not an edge. You're looking for, does this strategy make money? It does. It's not the best performer, but I've got to admit, Zeke, it should be in your universe of stocks. It's a good swing trading stock. Again, let's just look at come back to Halliburton, then we're going to look at a few others. And one of the stocks that we looked at, so again, Halliburton we just looked at. Let's check out Apple, everyone's favorite stock. In the last 20 years, should I have traded Apple? Of course. Of course you should have traded Apple. Should I continue to trade it? So yes, it should be in my universe. Looking at the last 20 or so trades the last 1 to 2 years. Something, I don't know if you noticed, but something weird went on in the last 1 to 2 years. Should I continue to trade it? It's those little green dots mean that it's making new equity highs. The strategy is still performing, not just long term, but in the short term. That's what I'm just checking there. And it's just a visual representation to say, should I still be trading this stock? Yes, I should. That's all we want to know. Let's check out the deets. Classic trend trading, four rules, 54% of the time. Again, not as good as the other stocks, doesn't matter. I would be happy with anything over 45%, personally, just based on this. Short trades is what we're seeing here. Maybe we don't trade it short because it loses money on the bear side. Oh, that's important to know. Apple is not so good on the bear side. So maybe we just ignore bearish setups. That's interesting to know. Despite that, all trades, 54% of the time, $1 in, $2 out, $100 in, $200 out, $1,000 in, $2,000 out. You're making money. That's what we want to know. Non-compounded. So Apple is a good, unsurprisingly, a good stock to trade. Now, when we went, for anyone who's been following me for a while, one of the stocks that we looked at when we were saying the market's going to potentially sell off, we looked at BHC as a bear candidate before the eventual sell-off. So let's go and take a look at BHC. This was our pick for a potential bearish stock to get positioned ahead of a market sell-off. We looked at the range, if you remember. There's the breakout. There's the move. It looks like it's continuing. So there was our trade. We call just calling back to a trade that we had some reasonable success on. So let's look at the deets. We're winning 45% of the time. We are making money. The profit factor is not fantastic. So just keep that in mind. So maybe we think about smaller targets and tighter stops is all I'm thinking. That could be something that I would consider there. Let's check out the equity curve. It's been shit, then great. And in the last short while, it's not been fantastic. And you can see visually it's getting you in and out here, mainly because we're seeing that consolidation. But nonetheless, should I be just classically trend trading that right now? Maybe it's not the best candidate for me to consider right now. So if, now here's the caveat, excuse me, here's the caveat. Am I going to blindly take every trade that sets up on BHC? No, for the reasons I've just mentioned. It looks a little bit rough around the edges. It's positive, but it's losing money hand over fist in the last 20 trades. The stats, the profit factor wasn't attractive. Again, I'm looking for that 1.7 profit factor. It was 1.4. It wasn't great. So if I'm going to trade this stock, I need some extra information. I need what I lovingly refer to with all my students is an O and. I need some extra information. And that means that then if I'm going to trade this, it's going to be situational. It's going to be one time. I would look for the consolidation. I would trade the breakouts. Again, tie that in line with the market selling off. We did our bearish analysis on the market, and we came up with this as a potential bearish candidate to profit from a downward movement that may have occurred in the market. That's what an O and piece of analysis. There's an extra reason to trade this, but I'm not going to blindly take every buy the dip or sell the rally opportunity because the data doesn't support that decision. Does that make sense? So I'm not saying that you can't make money on this stock, but what I'm trying to illustrate is it's not something that I'm just going to trade rain, hail, or snow, win, lose, or draw, whatever happens. Apple's a good example of that. Apple is a stock. I am just going to place a trade on it every time when it sets up, whatever happens. I'm not going to question it. The trade sets up, the trade goes on. Don't think about it, Phil. Just put the trade on Apple. That's what I'm telling myself here. When we go back to BHC, like it's profitable. Profit factor is not great. The details don't look, fantastic. Maybe I need something extra. That's what I'm saying here. So I'm not saying no. I'm just saying I want to do some extra analysis. And if you're at the new end of the trade spectrum, if you're brand new to trading or at the newer end and you've not developed those discretionary skills, then yeah, it's going to be, don't need to trade the stock. There's plenty of stocks for me to go and look at without having to find a trade and do what I sometimes refer to as the stock market equivalent of Where's Wally, and go hunting and looking and trying to find and lifting the rocks up and forcing a trade setup. Don't need to worry about that. I can just look at the stocks that make the most sense. Looks like we're getting that sell-off. Look, we spoke about a sell-off yesterday, folks, didn't we, in our insiders thing? So I can go through, and again, we'll wrap it up here. We'll land this plane in a moment. I can go through and validate the universe of stocks. Again, this is my massive list of super duper ding dongs, the trades that do well. Why are they in my universe of stocks? Because they perform well historically. I'm not going to think about the trade on many of these stocks because they consistently perform and make money. They've got steady equity curves. I'm going to trade them. I'm probably not going to think too hard about it because they're consistent producers. If I come across a stock that is not fantastic, then maybe I need some extra information to say, you know what, in addition to the classical trend setup, maybe I need a pattern. Maybe I need some extra analysis. Maybe I need to evaluate the markets. And that for me requires some extra time at the desk to consider a trade entry, like with BHC. I'm going to need some extra information to take a trade on, just because I can't blindly follow some stocks. I can't blindly follow some setups because it just doesn't make sense to follow some of these stocks. Does this make sense? Is everyone happy with the logic? Everyone happy with automations? Everyone, more importantly, is everyone happy with why it's important to have rules? Not just because we can automate them, although that's cool, groovy, and sexy, but it keeps us on the right path, the right track. It means that I'm doing the right thing. Like, I've got absolute confidence in what I'm doing because, again, there's 4 rules that we use for trend trading. Buy the dip. I've quantified what a trend is with 3 rules, and I've quantified what a dip buying opportunity is with 1 rule. Those same criteria can be used to manage a trade. Now, that gives me confidence to go, you know what, I'm probably not thinking too hard. I'm probably going to put the trade on. The only thing that is making a difference with when I'm taking action on what I'm doing is just how I'm reading the broad markets. And all I'm really doing there is trying to decide on whether I'm placing the trade today or I'm waiting until tomorrow. And all I'm trying to do there by reading the extra market conditions is manage my ability to trade. So a lot of the analysis that we did at the start of the show of this week's presentation, it's not necessarily because automation doesn't work. It's just I'm trying to also keep a finger on the pulse of the market, which has quite literally turned around. Trying to keep a finger on the pulse of the markets so that I can speed things up or slow things down. I can actively and more aggressively look for long trades because we're at range lows on the down. Maybe I can actively and aggressively look for bearish trades like we did 3 weeks ago to say, you know what, I think the market as a whole is at a potential tipping point, a turning point, which is what we did. I can go and actively apply trade management, hedging, get some bearish positions on, take profits. So what I'm trying to do with some of the discretionary elements, again, that we start every week with, it's almost like turning the dials on the production line. Okay, I'm going to speed up the trade management. I'm going to slow down the new long positions, which is what we talked about last week and the week before. And with the benefit of hindsight, that was exactly the right thing to do. But it's the same evaluations, the same lens of evaluating the market movements. Are we going up? Are we going down? Are we in a range? Great. Just where are we in the context of the trend? Great. We're at range lows or we're in a dip buying opportunity. Great. That means that we're probably going to see lots of dip buying opportunities set up. But just because the market's selling off doesn't mean it's an automatic buy. We need to wait for that price to turn around. We've got the right stocks, the right strategy to apply that logic. And again, I'm just thinking about the production line metaphor. Because the way that we read the markets, I can slow down bullish entries, speed up trade management, and speed up bearish entry opportunities because we think there's going to be downward movements. And the market rallying is going to provide a rally in a downtrend, like we saw on Alibaba, for example. Let's go and look at Alibaba. So like we saw on Alibaba, you know, there's plenty. So the market rallying, when the stock market rallies, and, you know, right here, we think there's going to be a market sell-off, then maybe we can be bearish on Alibaba because we're selling the rally in a downtrend, going into what could be a retracement or a corrective move in the broad market. So again, slow down the bullish trades, speed up trade management on the same bullish trades, and speed up looking for, or more actively look for bearish opportunities, sell the rally in a downtrend. Great. Maybe we just go and look for those bearish opportunities. And that's what these columns here on the watch list here. I've got bearish trades. I can sort all the stocks by bullish or bearish candidates. So PayPal's in a bearish trending state, Zoom's in a trending state. British Airways. I do this every time. Boeing, it's the same ticker in the UK. Boeing is in a bearish state. You know, we've got Alibaba in a bearish state. So it's very easy to go and look for opportunities when we're very clear on what are we looking for. Coming back to the original point, it all starts with what is the damn trend? And even if we didn't do some of the discretionary things just to speed things up or slow things down, look at a small basket of stocks. My universe is predominantly about 50 stocks. I'm only looking at the 50 stocks. How did I choose those 50 stocks? With the algorithms. I've got 3 of these bad boys. You know, I've got 3 variations of the same strategy. I've got a classic trend. I've got a strong trend, the range rider strategy. I've also got a variation of the classic trend, which was the original version without the money management that we've just been going through. And so I've got a universe of stocks that have been predetermined, pre-filtered, that have stock options, because I'm going to trade with options. That's how I prefer to trade. And I've validated all the stocks that these are the right stocks in my universe to trade a trend trading, swing trading, classical trend, strong trending strategies. And not only that, they are the best performers that are also in my universe. So I've got the best performing stocks in my universe that have historically consistently produced the goods. And that means that I don't have to think about it too much. You know, fast forward 28 years, it's good strategy. You've got an edge. It's quantifiable. We've just proven it. We've now also got a small universe of stocks, the right candidates for the right stocks. That's going to give you an extra advantage on the markets. So when you put all these things together, you should be able to make money. And I think, folks, just checking the time, we're a little bit over. Thank you for bearing with me. Right, and just because I like it, and what we don't want to do, no more zombie trading, no more flicking through chart to chart, wasting time, hoping the next one is the one. That should never happen for you anymore, just because I like the slide. Right, folks, what was your biggest takeaway today? Thank you very much for your time, obviously, and your attention. It doesn't go unnoted. We could always be doing other things with our time, but what is your biggest takeaway today? Zeke, thank you very much for your kind words. Excellent session. So what was your biggest takeaway today? And Zeke had to step away. Very good. Zeke says, I've been working with Phil. He's been consistent for years. I think that's code for I've been saying the same thing week in, week out for years. He's got to go. Oh, thank you very much, Zeke. I know you watched this on the replay. I've been his go-to trader for over a decade. Thank you very much. Okay, I don't know if the chat box is coming through. Oh, there we go. It was. Maybe I was just impatient waiting for people to chat up. Randall, thank you again for being involved. So awesome, but never thought of the doctrine of consistency and verifiable processes. To be fair, if you think about it, I mean, the factory, was it Henry Ford kind of popularized the original production line? You know, if you think about it, like the manufacturing process, we take it for granted with in other areas of life in business, usually manufacturing of physical goods and products. Farming has a process, manufacturing has a process, making cars has a process. Pretty much everything else in the world has a process to it. Why should trading be any different? We want to be consistent. And again, I think as soon as we go into the real world and start thinking about bricks and mortar business, you kind of take it for granted that you've got standard operating procedures. If it's manufacturing, you've got a process. And then that has actually created kind of like a subculture with, what's the Six Sigma, is it? The manufacturing process of how to create excellence in manufacturing process. If you can squeeze an extra percentage, there we go, Six Sigma, thanks. You can get an extra measure of performance out of a part of the process, that can potentially save millions. In our case, we can find opportunities and get in and out of opportunities very, very quickly with the same, as you said, verifiable manufacturing process, but applied to the trading world. So yeah, thank you very much for your vote. Once again, folks, I just want to acknowledge each and every one of you for taking a moment out of your time. Thank you. I am fully appreciative of the time that you give me. It's the most precious thing that anyone can give. And I wouldn't be doing this without you here. So it really does make a big difference. So thank you from the bottom of my heart again for deciding to spend some time with me today away from your other commitments and basically other things that you could do. So thank you very much. If you got any value of this, all I ask is that you share the replay with 2 people who need to see this or one of the past replays. I would also ask that you put into action what you've learned. At the early part, the thing that you can take away, hopefully, because I appreciate if you don't have the algorithm, you can't play with it. The thing that I would hope that you would take away was the trend. The trend, for me, that was a very pivotal moment in my trading career. It was quite literally a tipping point. When I determined and defined what I considered to be the trend, everything slipped into place. Whether you use my trading system or someone else's trading system, I don't care, as long as you have a trading system. But just apply what is the trend first. And whatever you and however you decide to trade on any time frame, any methodology, assuming it revolves around some form of swing trading, if you apply the trend first, what is it? The 6 money-making patterns, it's going to magnify the strategy that you're trying to apply. It really is beneficial. As I promised you at the beginning, there is a commercial intent. If you want to go further and you need some extra help, you are invited to work with me. That's it. That's the pitch. You can go to my website. There's a link in any of the emails that you receive from me. You can go to productionlinetrading.com. That will redirect you. It's nice and memorable. I have a group accelerator that you can work with me. I have no capacity at the moment for one-on-one mentorship. You're going to be into early next year is the next available time. But if you want some assistance and you want to speed up your development, if you want to learn all the systems in minute detail, then feel free to get in touch. I don't know if what we do is right for you until we talk, but if you'd like to have a chat in your particular situation, then send me a message. Again, you go to my website, productionlinetrading.com. And again, you can just click on the contact form or hit reply on any of the emails. On that note, one of the fastest ways to get in touch is to join the Slack group. Again, we've got, oh, there we go. Kevin, are you in it today, Kevin? Kevin's just literally shot a message. Zoom, the gift that keeps giving. 148% in 4 days. How about that? That's time, isn't it? Closed square for 103 in 3 days. Kev is absolutely nailing it. Absolutely spot on. So yeah, if you want to come and join the fun, there we go. Netflix, dude, what are you doing? You're on fire. On fire. Well done. Yeah, come and join the fun. Links are in the emails. You can go to my website to join the community. Yeah, you can send me a private message if you want to talk. Feel free to. The fastest way to learn how portfolio is managed is by seeing a portfolio being managed, and that is my invitation. Again, let's do it together. When you're ready, when you are ready, just go to productionlinetrading.com and we'll take it from there. All right, that was it, folks. Where are we? There's the slide. So thank you. That was automations. That was algorithms. That was the importance, more importantly, of rules. It's a systematic approach to find, filter, and sort opportunities that you want to find. How do you repeat success? You have a measurable and definable process to achieve and accomplish success as you measure it. I call mine a production line. If you want to learn it, if you want to know more about it, get in touch. If you're not sure, that's okay as well. All I would encourage you to do, and the thing that you can take away is to, if you have a successful experience, and I'm not talking about making money, although that is a byproduct of a good process. I suppose the thing that you can apply immediately is review your trades. Like, look back at the trades that were successful, that followed a structure, and start thinking about how can you apply a structure to the successes that you've had so that you can repeat them again today, tomorrow, next week, next month, that, and create your own production line. And all it is at its most basic is a structured checklist, a pre-flight checklist, a structured list of rules that is going to assist you in your decision-making process. The thing that I've learned multiple times over the years, and I was reminded again just after in about April, May last year, I got kicked in the shins, and I was reminded that I am not smarter than the strategy. I got caught trying to trade my opinion, and it was very expensive. So just keep that in mind. Just keep that in mind. Anyway, thank you very much for your time. Thank you very much for your attention. I'll see you all at the same time and the same place next week.